I mean, we're seeing distressed deals now. We're just not seeing them in the right quantity because the banks don't believe the value's there. As low as it is what I mean. Also, the banks are not in a position where they want to get rid of any of their REO at a number where it pops, and then they were misguided. So the bid ask has to stabilize, like what I was saying before, but maybe it's not too, maybe some people don't agree that it's 2025. I think it is, but at some point it's going to have to get to some stabilized point where everybody goes, that's the value, whether we like it or not. That $10 million loan is now worth $7 million. Take it or leave it. So that $10 million REO is now worth $7 million. Take it or leave it.
Hi, Adam Gower here, host of the Real Estate Reality Show on YouTube at youtube.com/GowerCrowd and founder of GowerCrowd.com. Welcome to today's show. My guest today is Bert Habucho, who's principal at Atlas Capital Advisors. He is an accomplished CMBS and bank workout professional on high dollar complex workouts, restructures, and litigations. And what you're going to hear about today from Bert is a discussion regarding office, of course, and also multi-family and the impact of delayed interest rate hike lag on those industries, amongst others. If you want to learn more about Bert, go to the podcast page at gowercrowd.com, and while you're there, sign up for our weekly newsletter. It's free. It goes out every Wednesday, and we cover the world of commercial real estate investment and finance with a focus on syndications and crowdfunding, all there at gowercrowd.com. All right, so let's learn more about the dynamics of what's going on in the market with a focus on office and, of course, multifamily from my guest today, Bert Habucho. Here we go. Bert, thanks for joining me today. It's a real pleasure. I've seen your face and comments repeatedly in my LinkedIn feed. I do find your title on LinkedIn says accomplished CMBS and bank workout professional on high dollar complex workouts, restructures, and litigation. Fascinating. So we're going to talk about these topics. But before I do, let me ask you, Bert, at Atlas Capital Advisory, one of the principals over there, what do you guys do over there?
Kind of three buckets. We do a lot of work with servicers and banks as third parties, either handling their due diligence, handling their workouts in some cases, in many cases, portfolio balancing. And then in some cases, now we're starting to see with some, hedge funds, et cetera, we're helping them acquire portfolios. We've done some borrower work, but typically we're creditor faced. So if we do borrower work, it's typically because one of the creditors has asked us to jump in. Usually it's a borrower who they think they can do a deal with, but whether it's personalities or the attorneys getting involved, it's, why don't you jump in and see if you can help us? And when I do that for the borrower, it's usually with absolute consent of the creditor saying, I'm in here to help. If you don't think I'm helping, I'm getting out.
Okay, interesting.
And then the third thing is, we do a lot of work for, 3 or 4 family offices, local family offices, where we just handle the real estate, whether it's their, their debt, they do private money lending, or acquisitions and dispositions for them.
Oh, that's really interesting. I had no idea. That's deep stuff. Bert, so let me ask you, it's just so that I do understand a little bit more. So when I was at Colony, or during the global financial crisis, and we haven't seen it since then, there were lots of portfolios, some very big ones, 800 asset portfolios. I mean, some big stuff. I remember when I was at Colony, seeing one of the guys, asset manager, just been hired and was given literally a spreadsheet with 800 assets on it and said, all right, go for it. So where do you start with 800? Day one, I had to.
Well, and it's funny, and things were a lot different then. You forget that this is, 2000, and I'm going back before then. I go back to RTC days. Where I got in. I was a lot younger than Tom Barrett, but he was at the JER and he figured it out pretty quickly. He says, "Why am I working on this stuff? I should just go buy it."
Yeah.
And those were when the portfolios. I think we're going to see a little bit of that now. We're going to see, sure, we're going to see portfolio sales, but I think what we're going to do is we're going to see the big money is going to be wait for just buy the entire bank or the entire bank portfolio. Kind of what we saw 4 or 5 months ago with, Silicon Valley or Signature or now, PacWest, where basically the entire construction, in 2 parts went to Kennedy Wilson, and the staff just went over there for the most part. They've got the money to originate, so they're going to be originating. It'll be high, it'll be high interest rates.
But what do you think the play was? Because they bought construction loans at a slight discount from the bank. What's their play? Are they anticipating those loans to be unable to refinance so they can take ownership of the assets and lease them up themselves, or are they looking for an exit? Like full payoff? What do you think the play is over there?
I couldn't tell you. I know in the past they've done it a different way. I know that they typically would turn around if they would buy a portfolio like that. They'd buy it to work it out. I'm not sure. I don't think we'll find out. I don't know what the discount was on that portfolio. Everybody says it was slight, but who knows what slight means. Also, I don't know how much of the portfolio was dispersed, how much of the loans were dispersed as a percentage of the portfolio. Was it 50% dispersed? Was it 30? I mean, the lower it is in the disbursements, the more you can slow down the process. It's not fun to do. It's not right to do, but you can do it. And sometimes you can get out simply because you haven't spent too much money.
Well, if you want to, you can trigger material adverse changes. And this is what some of the banks...
it's funny that you say that. I'm seeing that with some banks. I was called in by a bank, and it was kind of interesting. They called me in. They don't want to touch they know they have a brewing pot of a disaster on their non-performing, their sub-performing. But what they wanted me to do was look through the portfolio at the deals that were performing, where they had good borrowers, and try to find a way to find little covenant breaches so that they can actually extract something or wow. Their loans were 3.25%.
Yeah. So
they're saying, okay, is there a way that you can look at Adam and his loan and find a way to basically tweak it so you can say, hey, sorry, but you're in default now. Either you pay it off in full or you jump up to 6 or 6.5 or
oh my goodness, that's hardcore, really. That sounds like survivalist play there by the bank.
And it misses the point. The point is the bad stuff is right behind you. You should start dealing with that. That's what's going to kill you as a bank. And I think that's what we're going to see in the fourth quarter and the first quarter.
Well, let's talk about that. What are you seeing now? Okay, so you do. Let's talk. Actually, let's come down the food chain, because you've said the big money is going to buy banks. Okay, that's one start. But let's kind of come down the food chain to mere mortals. The next level is portfolio acquisitions of loans, and I've actually had a couple come across my desk. They're not pretty and not interesting yet. But what are you seeing in terms of portfolios, non-performing loan portfolios?
I'm seeing not interesting. I'm seeing the same thing as you. They're not interesting. The bid ask is still very, very wide. If you have a bank that is still solvent, they're not in a rush to do the discount they need.
Well, you've also got actually
the
just
value isn't there. The value isn't there.
Not there.
Yeah, that's the biggest problem. And, when you look at the community banks, another thing you have to look at is how many banks are there in the U.S.? Most people just don't focus on that. There's 4,780 banks. Yellen made a big deal about, I looked at the top 20 and the top 20 are great. And yeah, sure. We all knew that. But she didn't talk about the bottom 4,700. And if you look at the bottom 3,000, I think they're probably under 5 billion or 20 billion. You go to the next 2,000, the lowest 2,000 are probably under 5 billion.
Yes, very small.
And then you're getting to small banks.
Yeah.
And I think the problem with the community banks or the community type of banks, the smaller ones, is if they're lending across the street they probably also lent the other side. So if this loan goes bad, they have to admit the other one's got to be valued as well. And then the whole portfolio just starts to spiral downward because of one or two or three bad loans.
Yeah.
So what they do is they just don't admit anything. Just, monkey, the whole, I don't see anything. There's nothing to see here.
Well, there's also the challenge that banks have. I worked for a major bank during the, as you know, and the challenge is, it was actually, for being a real estate guy, it was absolutely fascinating being actually at a C-suite level inside a bank that was going through what East West was going through 15 years ago. Because I understood the DNA, I understood the thinking, and one of the biggest challenges I think the banks have is, number one, you don't want to advertise that you've got troubles, because that makes investors and depositors skittish,
right.
And also your borrowers, right, as well. Like, what are you going to do with my loan? You're worried about. But then you also have, the personality or the personal relationships that loan officers have developed with borrowers, and there's this instinct, natural human instinct, to do what you can to help, right? You don't want to foreclose. You don't want to necessarily sell a loan. It's tough when you've got an actual relationship with a borrower. It's actually one of the reasons why it's good to keep good relations with your lender if things are going bad, because they can help you.
Well, that's what I tell the borrowers that call me. I tell them, number one is get in front of your lender and do it right away. Do it as soon as you can. Don't wait too long. Don't ignore their phone calls. You should be the one to offer the pre-workout agreement. Don't wait for it to come from them. From a banker's standpoint, if I have to chase you to get a pre-workout agreement, I know what this workout's going to look like. It's going to be a disaster that'll never happen. You're basically just there to keep me on a string while you suck all the cash out of the property, is the way I look at it, whether it's true or not. It's just, but if you approach the bank, you say, okay, what do you need? What do you need from me? I'll help you. I need help. For the most part, the bank will do what they can. Sure, there's some bankers who just look at the values and say, you know what, there's no reason to help you. I'm just going to take it. But most of the time, you'll do way better by getting in front of it fast and, offer them your financials. Be current, offer them bank statements, show them what you're spending, show what's going on. You say you have, you need money for CapEx, show them what you need and how you need it. Bring them to your property.
Yeah, it's a really good thing to do, because you then put the bank, educating the bank on the status of your project is helpful, because it also gives the loan officers a sense of reality, because otherwise all they're looking at is the loan docs, the original due diligence, and heaven forbid, an original appraisal. So in their mind, all we have is this, $10 million project, and you've stopped paying on your $7 million loan. But if you go in and explain, hey, look, this is what's happened, et cetera, and the value of the property is now less, we've come to realize that, let's work something out. It just helps the bank, and it helps your lender to realize this is a tough situation, and the best person to deal with is the borrower.
I mean, you can't help it. You're the loan officer. You're sitting, 1,000 miles from the property. This borrower calls you. You look at them. You say, "I'm sure he's just not telling me the whole story. Things are probably not that bad. This guy just heard on the news something about this virus, and now he's hearing the name is COVID, and now he's hearing that people are getting a break, and he's saying, help me." And sure, a lot of people got a lot of help that didn't need it. But you can't the presumption is not innocence from the loan officer standpoint. So I think you have to educate them. You have to bring them down. You have to show them the problems in front of your property. Maybe you can get them, if the property is big enough, you bring them over to your property, you show them you take them, you drive the neighborhood, you show them what's going on. It's not just my property. Because obviously from a lender standpoint, it must be Adam. Let's just get rid of Adam. That'll be the solution. Only to realize that it wasn't Adam. It was
exactly. Now they've got an even worse problem.
Right. Now they put in a receiver, and the receiver may be doing a great job, but it's costing them a lot more money.
Regulators have recently been encouraging banks to extend loans and to work with borrowers. It's very different from the last downturn, isn't it? But where every bank was mandated to market their entire portfolios to market. And that's what really, caused, I mean, that was a very prudent thing for regulators to do then. But it created vast amounts of non-performing assets almost overnight on books. What do you make of the regulators' encouragement today to, that they should be working with borrowers to extend loans and terms, even if just for a short period of time?
They've always been doing it. I think the purpose of that, as far as I'm concerned, was really to just let everybody know that don't worry about having to do the reserves, the specific reserves, the general reserves. Don't worry about, having to, do loss calculations right away on these loans. Just keep them going. But, this happened at the beginning of COVID. This is a rule that's kind of been out there since COVID for a lot of the banks. It's like, okay, you know what? We won't consider what would normally have been TDR, a temporary debt restructuring. They're calling it something else now, temporary note, whatever.
They're not TDRs anymore.
Yeah, there's something else. But
it's wonderful when all the acronyms change.
Yeah, you might as well, right? Update.
Well, I'll tell you something funny. When I went to East West, the division that they put me in charge of was called the Special Asset Division. And so I'm not working for that division. We're going to change the name. It's going to be Special Asset Group. I'm not working for anything. It's SAD. Basically.
Well, that's what it was. That's what they were called back then.
All right, go on. Sorry, I interrupted you. But the regulators, what are they signaling?
This has always been going on. I think it's really just a way to let the bankers know they've got another free pass. I mean, if you can keep the loan, if you basically saying, you know what, kick it down the road and we won't penalize you for it.
Right, but there's more to it, though, surely. So here's my thesis, all right? So this is what I think. What I think they're signaling is an anticipated reversal of Fed policy. Because the second, let's say the Fed increases rates a couple more times this year, which is widely expected, right? So we go up another 50 basis points, at least before the end of the year. But at the beginning of Q1, Q2, even into Q3, right into election season, I mean, the world is going to look very different next year. If the Fed reduces rates, what's going to happen? That's not rhetorical, but I'll answer it anyway, is all the money is going to flood into the market because everyone's going to know, rates are coming down. If we're going to buy, now is the time to buy because prices are going to start going up again. Don't you think that seems to me that's what the regulators are signaling? It's okay, guys, extend for a year. Things will be better next year.
Yeah. I'm not saying it's going to work. But yeah, I mean, that's what I was getting at. It's an extend and pretend thing all over again. We started with the servicers in 2009. In their presentations, they literally actually kicked the can down the road, down the aisle of a conference, and that's how it started.
No, are you serious?
It was very interesting.
That's crazy.
So, I mean, we've been doing that for 15 years. And we'll keep doing it. Banks are in trouble. I don't care what, I've been speaking to a lot of banks. Over the last month, we were in Dallas, we were in New York, we were back in Dallas, we were in Austin. We obviously are, in California. And, quietly the banks are saying, we know we've got a torrent of loans coming. Whether they're all going to go to a loss, that's not going to happen. You're not going to have this major loss across all these banks with all these loans, but the loans are going to be in trouble. The borrowers are going to be in trouble just because the loan is still barely hanging on and you've got 100% LTV. How do you get at that? Like to your example, it was a $10 million purchase. It's a $7 million loan. The loan's now 6.9. The value is 7.1. What do? You can't even sell it and pay the brokers.
Well, the other thing is that you also the biggest problem is less the LTV and more DSCR. Sorry to keep throwing out these acronyms, but right. Debt service coverage ratio, the extent to which your cash flow can cover the debt service. And as soon as that goes negative, that's when it becomes a real problem for a bank, doesn't it?
So here's what one of the banks did. And I looked at them and I said, guys, this is really a boneheaded move. So it was back to that example where they were just trying to, leech cash from good borrowers instead of attacking their bad debt and creating what they thought was a bigger nightmare. And they're going, here, if we take this guy's loan at 3.5 that's performing, and the guy's great and he's wonderful, and by the way, he's got a ton of money in the bank on deposit with us. If we take his loan, we show him this covenant breach. Now we have an excuse to go to whatever, 3.5 to 6.5. And by the way, at 6.5, you don't debt service, so you got to pay it down. So they go, look, it's a double win for us. I said, you guys are insane. This is your good stuff. Why don't you wait? It'll happen on its own. Don't rush it. Go attack the stuff that is in trouble. Go approach your own borrowers if they're not approaching you and saying, hey, you know what? You're having trouble in this deal. Let's talk. Get those out of the way. Now that you have the breathing room from the feds to basically say, okay, go start doing these temporary deals or these modifications, do them now while you can. I'll give you a month off or whatever. There's a broad book of, what lenders can do now under the guise of don't worry about it. And nowhere in there did I read that they have to mark anything to market.
No, so nothing at all. Yeah.
It's a beautiful thing if you're trying to hide the fact that your loans are underwater.
Now, so first of all, you're very good. I love your commentary on LinkedIn. Thank you for that. You pop up all the time in my feed. But I also saw an article you wrote, or at least you were quoted in Wealth Management Real Estate, and you talked about different asset classes as well. So what are you expecting in terms of maturities and problem loans, problem deals across the asset classes?
It's interesting. Obviously there's a little bit of a softening in industrial, but it's not enough to even move the needle. I think that's for the most part, unless you've just, created your own disaster, you're going to be okay industrial. Retail is still a tale of two cities in a way. I said this 15 years ago. We were talking about vacancies. And it wasn't 15 years ago. So I'm dating myself. I will date myself now. It was probably during the SNL issue. And even then I said, it's not.
So let's just get straight on that. It's not 15 years ago. It's actually 30.
It's actually 30. Yeah, it was just as I started. And, it was a question with shopping centers, the malls of we were under demolished. It wasn't that we had a vacancy issue. We just had too many old, tired malls that really shouldn't be around. And I think if we start up at in the offices today, we have a vacancy issue, but really we have, if you look at New York City, for example, you've got all this B and C quality office product that really, if you got rid of most of it, you would take care of a good chunk of the office problem. And a lot of it, is obsolete. There's just too much. It's not just a vacancy issue. That should be something else. It should be apartments. It should be affordable housing. It should be, name it, but not an office. I think, there was an article that came out. It was a study by McKinsey, and they basically looked around. They said, we don't think we're going to get to office values. The office values it'll take till 2030 to get to the values of 2019. And even then, it won't quite hit it. And I think that they're right. It's office has to become something else. The hybrid work, that's going on right now, that we need some sort of hybrid office building. That's what's going to happen. You're going to have an office building that's going to be, okay, you know what? We can't afford to take the whole thing and make it residential. It's too expensive, but, let's take the bottom 3 floors, make them residential. Maybe office up top, maybe something else. And those are the ones you keep, and some of them just have to be demolished.
What about apartments? You did mention
apartments. I think the issue, there's a lot of apartments. It's not necessarily in the right part of the country, but there's a huge supply of apartments that came online. That in some areas there's more apartments than supply. It's not to the point where it's not going to lease out, to the point where you see that rents have actually gone down. They haven't gone up. I think the other issue is what you're looking at is, the maturities on bridge loans or apartment debt that was taken with variable rate loans. Mm-hmm. Those are going to be very hard to finance. Those were financed by a lot of, smart people, but made, to me, tragic mistakes. There was no assumption of the world's changing in any way, in a major way. You have cap rates, terminal cap rates that were within half a point of your exit caps were the same. Your assumed debt, interest rate was the same. If you wanted to show that you were being conservative, you raise it by a half a point.
Exactly. And now, are the banks, Bert, are the banks that you're talking about multifamily yet or not?
Yes, we're seeing multifamily. We actually were asked by a bank to sell a portfolio of multifamily loan. That is fine. It's performing, but the bank's point of view is it's going to be very hard for these guys to exit. So let's sell it now. If we have to take a small discount for it, let's do it. And probably the people that are going to buy them are the people that are not afraid to just take it.
Who want the asset, you mean, right? So if the borough can't refinance, that's fine. We'll foreclose and take the asset.
Yeah, you're going to see. We're already seeing the vultures. I mean, it's happening.
I love this term. When I started at the bank, everybody had these derogatory terms for those people who I thought, these are the guys that are going to actually save you, right? The sharks, bottom feeders. There was like this whole lexicon that was
no, but it is, but it's not. Well, I'm talking about the people that will make a loan, but not for the sake of making a loan for you to get out of it. I mean, we used to see that. Right. I had a client who was a ABL lender, a hard money guy. Mm-hmm. And what he would do is somebody would come to him and say, I need $900,000 and I need it for 18 months. Mm-hmm. He'd look at the building. He'd decide he loved the building. He'd say, you know what, instead of 900, I'm going to give you $1 million, but I'm not going to give it to you for 18 months. I'm going to give it to you for 12. So basically he pushed the guy into a box that he couldn't get out of. That's my definition of a vulture. It's not a guy who's there to be your friend. It's a guy who's there.
Who wants the asset, wants you to fail.
My point about this with the banks and the multifamily is the guys who are buying these loans today, the people that I've seen buy them, are guys who have the ability, the experience, and aren't afraid to own it if they have to. So their book is different. They don't have to translate it into a payoff for their investors to go, well done. If they translate it into, look, we couldn't pay it, they couldn't pay it off, we took it, we're keeping it, or we're selling it out, foreclosing, that's part of the business plan. It's okay. It's another exit for them. It just makes them look better. It's not their goal. It's not their primary goal, but if it happened, it's not necessarily.
Well, you always invest in something that you don't mind owning at the end of the day, right?
That's the way it should be.
Yeah. So one of the things that you talked about in this wealth management article that nobody yet on the podcast has discussed, I'm going to ask you about, is the idea of the A-B structure. A-B structures on loan workouts. So do you want to talk about what that looks like? What is an A-B structure on when a borrower goes to their lender and needs some help? What does that look like?
It's a broad term. People structure it different ways, whether you're a servicer or whether you're a lender, whether you're hedge, private equity, but the structure essentially is we have a note that's, let's say you have $125 million value, you've got $100 million note. The value today, by call it most calculations, is $80 million. So the idea would be, okay, you know what? I will give you a note. I will restructure it into an A note of $75 to $80 million, and a B note that is the balance up to the 100 million. So call it a $25 million B note. And within the B note, it essentially says either it's a progress payment, it's net cash flow, whatever's left. But the idea is what happened, let me back up for a second. So what happened 25, 30 years ago is a lot of banks just got rid of stuff for nothing, pennies, and then turned around, and sometimes within 6 months, they'd see that somebody flipped the loan or the asset and made so much money that, the asset managers or the lenders or whoever they were, had egg on their face. So now they turned around, and this has been around for a while. They essentially say, okay, this is a way for us to recapture. If you can only sell this asset for 80 million in 3 years, then that's all you pay us. But if you hit a home run and the asset, magically releases and, you sell the asset for 125 million or 150 million, we want our 100 million back, all of it, so every penny of it.
That B note is known as the hope note. This is something that, right? This is something that banks offer borrowers. Is that right? So these are the kind of things that you will, part of the arsenal that you put in place when you're doing a workout, is to restructure an A and B. Yeah,
I don't know if it's an offer necessarily, but I think it's in the, it should be in the arsenal. I've done it a lot on the special servicer side. I've done it a lot on the bank side. I've done it on the private equity side. And it's a way for us to essentially ensure that, because this is a different market, though. I think this will apply in a lot of markets. I'm not sure that in this situation, I would think a hope note, you have any hope of getting that money back on an office product today.
Right.
Unless that hope note stretches a really long time.
Really long.
I think you're going to have a lot of suffering in the office market. And I think you're not going to see a change. I think you're going to see the beginning of the bottom in 2025. I think a lot of people say 2025 is when we're out. I think 2025 is when everybody looks back and say, okay, it's been stable for long enough. This is now the bottom. Now we can go on.
Really interesting.
And I think that's when you're going to see a lot of transactions. If you're seeing transactions now, you're going to see more in the fourth quarter. You're going to see substantially more in the first quarter of next year. But I think when everything flattens, it'll probably be 2020. And then you'll see the broad increases, because then we'll have dealt with a lot of this. It'll take us 2 years to figure out, at least 2 years to figure out, okay, we know that these, 38 office buildings are going to stay vacant forever. What do? Do we tear them down? Do we try to do something else? You can't just, adaptive reuse and magically turn something into an apartment building.
Right.
Sometimes it's in the wrong neighborhood. There's no amenities below. Yeah. Sometimes the footprint is wrong. And sometimes the cost is just prohibitive. If you're going to spend $300-400 a square foot converting something that's up and, you better be buying it for nothing or possibly less than nothing, which means tax incentive, government help.
So we've talked about the world of the immortals going out buying banks, and then the next layer is buying portfolios of loans. But what about investors, professional investors looking for individual notes? What are you seeing coming to the market? What do you think is going to be coming to the market? And are there any examples that you've got that you're working on at the moment?
I've got a few examples right now, and usually they're not easy deals to do, but there's money in them.
Can you give me an example? Let's give me an example. By the way, while we talk about these examples, I do want anybody who is listening and not watching to know that behind Bert on this video are two large wolves wandering
around.
When we were talking about sharks and vultures, Bert has wolves walking around his office.
Yeah, it makes a point when I go
They're
see a
fluffy.
Right. Yeah.
Anyway, sorry. I hope you don't mind. I kept wondering. Oh my goodness. I hope. Thank goodness this is Zoom. All right, go on. So give us an example of a loan that,
we saw an apartment building that essentially had, the borrower had not kept up with it. This is LA, so it went to something called REAP, which is essentially rent
stabilization,
rent as abatements, and I'm sorry, another acronym I now forgot. But essentially, what happens is the tenants pay the rent to the city, and if they complain enough, the rent is not full rent. It's almost like the city turns around and says, "Okay, poof, you know what? Your $1,000 a month is now $500. That's your full rent. Just pay that every month, and you're considered current." And the borrower's not getting that money; it's going into an account, and then he's got to ask every month and say, "I need money for this. I need money for that." So there was a building that got into that. The lender just, couldn't figure out how to get out of it. The debt service wasn't there. The guy was making payments that were 1/3 or less than monthly payments. The value, because of this REAP, was horrible. There were a lot of things that weren't done that needed to be done to get out of REAP. A lot of capital improvements. There were plumbing issues. There was heating issues. The city of LA doesn't really, it wasn't so much about the air conditioning and stuff like that, which wasn't working. It was more about the heating that wasn't working. The electrical. Somebody would plug a toaster in and half the building would go out. So this was an asset that should have been worth, it was a small asset. It should have been worth all day long, $4.5–5 million. We ended up selling it for the bank because we said we can sell it. The timing was good. It was at the end of a year. They wanted to be, it sold before, you remember that, the quarters and the years.
Yes.
And we sold it for, I think, $3.1 million. The buyer sat down with LA City, went through it, got their code enforcement guys, kind of like what we were saying before, got them in a car, got them to come spend time at the property, told him what needed to be done. They told him what they didn't agree with. This went back and forth. He got it all done relatively quickly. This could have taken 6 to 9 months. He did it in about 45 days. Property came out of REAP. He got all the money that was in there, whatever was in that mini slush fund, refinanced the property within 6 months for essentially what he paid for it. So he ended up buying it for $3.1, probably spent $150 in CapEx, got about 100 of that back from LA REAP, ended up refinancing at 3.1. So essentially he bought a building for nothing. And
that was the bank that brought that to you, right?
Yeah, that was the bank.
And are you seeing more of those kind of?
I'm seeing those. There's another one I'm seeing.
As well. I mean, that's
hairy. Another one I'm seeing. The bank basically came to us and said, we've got a building. We've got a building on a ground lease. Borrower's not paying. So then it was a matter of detaching everything and looking at the property that was there, as well as the ground lease and the value of that. Unfortunately, it was one of those ground leases where it was a 50-year ground lease, but it only had, 11 years left. What do you do with that as a buyer? You're going to go and renovate a building that needs to be renovated. You've got, a 10-year strict amortization basically on your money. And then your salvage value is zero. There's no salvage value. You get nothing. So it almost like buying machinery for a factory. I'd have to underwrite your loan.
Yeah, the ground leases can
rates at the end. There's, there's none of that.
Yeah, it just evaporates. That's right. It's like a lease. It's basically buying a lease, investing in a lease. Do you anticipate more individual loans coming to market? And if so, what will be the pathways that they will find to the market, do you think? Not just loans, but also distressed deals.
Yeah, we're seeing distressed deals now. We're just not seeing them in the right quantity because the banks don't believe the value's there. As low as it is what I mean. Also, the banks are not in a position where they want to get rid of any of their REO at a number where it pops, and then they were misguided. So the bid ask has to stabilize, like what I was saying before, but maybe it's not too, maybe some people don't agree that it's 2025. I think it is, but at some point it's going to have to get to some stabilized point where everybody goes, that's the value, whether we like it or not. That $10 million loan is now worth $7 million. Take it or leave it. So that $10 million REO is now worth $7 million. Take it or leave it. But I don't think we're there yet. So I think what we're seeing is just dribs and drabs, the kind of stuff like this one, the apartment deal, where it's just the value. There was no way that value was going to increase until somebody did a lot of work. And it wasn't the bank, because the bank was out of state. So they're not going to come into California and sit down and spend all this time with the city and try to figure out what's going on. They can hire a receiver to do it. That would have been even more expensive on a small deal like this. So they just sold it.
But what do you think? But do you think you've been through this as many times as I have? You've seen the savings loan, the RTC days, the global financial crisis.
.com.
I love.
Let's get them all.
.com. Well, .com. Yeah, I do remember the .com.
I had a hotel portfolio, so let's talk about SARS as well in 2002.
That's right. All these things, but the big real estate triggered ones. .com was .com. That's what kind of brought that down. But what do you think? Do you think we're going to start seeing some? Well, I hate to say this. I was at the bank. They were, head in hands, and I actually wanted to write a book about my experiences, because there was some cool stuff. It was a lot of fun. They did not want me to do that. So, like every time there's something, I still have jokes. It's like, to me, working at the bank on workouts and distress and selling all these, that was one of the highlights of my career. Right. Nobody I worked with had the same points of view. None of them did. But do you think that there's going to be more opportunities? That's what I mean by it. Well, the reason I went down that path was because, discounted, distressed opportunities are a good thing for some. Obviously, there's somebody on the other side, and you don't wish anybody pain or suffering or et cetera, et cetera. But the reality is a lot of loans are going to mature, be unable to refinance, and they're going to move to other owners. Do you think there's going to be a lot of opportunity like that for buyers over the next few months, or do you think it's just going to be dribs and drabs?
I think it's for the next couple of months. I think it's going to be dribs and drabs. Obviously I can be surprised, but I think it's not going to really start taking effect until, call it, after Labor Day, as we get into the the end of the third quarter. The fourth quarter, as they start looking at their financials for the end of the year, and okay, should we just call it a day and cut these loans? But it'll all depend on the pressure by
the Fed, the regulators.
The FDIC, they're hiring a lot of regulators, a ton of regulators. They're hiring a lot of people into the receivership side, which means bank takeover, not just examiners.
Really?
So they anticipate that there's going to be a shrinkage of banks, no question. Whether it'll be just 500 that some people are predicting, or will it be more than 1,000, which is what I think will happen. I don't know, but I think that that's going to push loans out into the marketplace.
But I have to, unfortunately, I want to talk to you a lot more.
Okay.
But unfortunately, I've got a call at the top of the hour. So I've only got a few minutes left. So let me ask you this. This is normally something. This is a secret question. All the viewers, you should know, this is one of my secret questions. It's one of the questions I only ever usually ask offline, but let's just go for it, Bert. It's a pleasure meeting you. Are you going to be a good source of distressed deal sales for people like me who are looking for discounted opportunities to acquire? Your shop, I mean.
I think we'll see them. I don't think I'll make I'm not going to set up a shop where, I'm, selling portfolios and selling assets and, setting up a whole brokerage team. But, by the fact that I'm in the banks, or I'm with servicers, or I'm with the hedge funds or the hard money guys, I am seeing a lot of stuff. And sometimes it's simply, would you sell this? I always ask the question. Sometimes it's, if you can get me this price without going to market, do it.
Interesting.
And that's how we sold the apartment building. And that's how we're doing the ground lease deal. And that's how we're doing a small office building. And that's how we're doing a small shopping center. They're not deals that I would normally chase. I'm not out there, chasing deals like, some of my friends who are, that's what they do. They do it for the servicers and the bankers, and they've got their teams, and they can do their due diligence, and they're BPOs. And I'm not set up to run around and just, tell you here's what it's worth. But I can tell you what it's worth if you, and I'll sell it for you.
Well, the funny thing is that when the market is where it is today, there's little point. This is what I learned during the last downturn, the global financial crisis, was there's little point doing a BPO. There's little point doing an appraisal. There's no point doing that. The only way to figure out how much something is worth is to find out how much somebody is willing to pay. And the best way to actually really put a line under that is to get multiple offers for an asset. Because what I found was that somebody always spikes the price. You'll get a bunch of offers, and you can usually tell, this kind of investor is going to offer at this end of the scale, and this kind is going to be here, and but then there'll be that bulge where everyone's in the kind of the same area, and then one person will offer way more for some reason. They see more value in it. Oftentimes it's the neighbor, or they see different kind of value in it than anybody else. And that is the value. That's how you determine in a market like this where the bid ask is so.
Yeah, I agree with you. And that's what I'm saying. I'm not going to see as many of those because I'm not out there marketing their property. The stuff I do for family offices, that's a different conversation. But here with the banks, it's usually a whisper of, I'd love to get these 3 deals off the books by, pick a number, June 30th. If you can do that for me, but it has to close by the, or I don't know, was the 30th of Saturday? Just want to make sure, whatever that's
last day of the month. Yeah, exactly.
If you can do that for me, I've got a deal. We've got a deal. And sometimes the opportunity is there because they know their price. And the buyer, like you just said, knows it's a good deal. He's like, you know what? I'm not even going to haggle with them. I'm not even going to do anything. Here's your check. I'll close it right now. Yeah,
sign and wire. That's exactly right. Yeah. Bert, what a pleasure meeting you. Let me sign off with one final question, if I may. It's kind of high level. What kind of resources are you using, or what resources do you like to use to stay in tune with what's going on at the moment?
I spend a lot of time, with, in the evenings with Bloomberg and with, it depends on what I'm looking at too. Sometimes we're looking at companies for, some of my clients. So sometimes I'm in, the equity side of it. But usually it's just staying in the market, just, spending some time, even if it's only 10 minutes per thing, whether it's the articles in CoStar, whether it's going through CoStar, which, is got a ton of information. You've got CoStar, you've got the apartment side, you've got LoopNet. Okay, those are asking rents, so it's not really necessarily what's going on, but it gives you a very broad way of looking at a market, especially if it's one you don't know very well yet. So,
Bert Habucha, Principal, Atlas Capital Advisory. An enormous pleasure meeting. I'm really glad that I called you to ask you to join.
I'm glad you did too. Thank you very much. Okay.
All right. That was Bert Habucha, who is principal at Atlas Capital Advisory. If you want to learn more about Bert, go to the podcast page at gowercrowd.com, where I have included links to his bio and to his company, and where you can subscribe to the Gower Crowd weekly newsletter. It's totally free. Goes out every Wednesday. It covers the world of commercial real estate investment and finance with a focus on crowdfunding and syndication, all there at gowercrowd.com. Bert, thanks so much for joining me today. It was a real pleasure to meet you, and I've been enjoying our after podcast email chat. Let's see if we can't get something going there. And thank you too, dear viewers, for joining us today. That's all for today's episode, and I'll see you next week. For now, this is Adam Gower signing off.